Okay, here's the trade that I'm about to place right now. This is USD JPY, and as you can see that we have all the three moving average moving to the upside, and then we have this zone here which was an area of value where the market reverses and touches my 9-period moving average right here. So right now the market have gone up and break above this zone here, making it a good breakout trade. So I'm going to place this trade right here. I'll put the stop loss at the low here. You're going to see the screen of my phone on the side. This is a live trade, so I'm going to do 1 to 1.5 risk to reward ratio. So this is going to be my take profit and stop loss. So this trade is going to take about 3-4 hours to play out at least, or maybe if the market consolidates it will take long, but I'm looking for to be completed in about 4 or 5 hours. Okay, so this trade is about to hit my take profit, and as you can see I've made around $93 on this trade. So what I'm gonna do here is I'm just going to close this trade right now with a profit of $92.52. In the past 5 years I've been looking into the market every single day, and I've used the moving average multiple times, and in this video I'm gonna share with you the real techniques that you can use to make money trading moving average. The moving average is one of the most used indicators in the market, but unfortunately most people lose money when they trade using the moving average, simply because they are told that you need to place a trade when the moving average crossover, or you need to place a trade when the two moving average crosses, or if the market crosses above or below the moving average. Well, it might help, but if you really want to make consistent profit in the market, you need a rules-based strategy that is around that moving averages, and you need other things to make sure that your moving average is going to perform at its best. So let me talk about the moving averages, and in the next 15 to 20 minutes you are going to become a good trader just because of this strategy. So first of all, we are going to talk about how the moving average is created. Now before we move forward, let me tell you about a website called fastable.com. Fastable.com is not only the sponsor of this video, but it is a website that can give you amazing results and improve your trading. Number one, you can get AI signals from fastable.com. You can also get professional analysis from professional traders on their website. You can also get economic events. Economic events are events that are likely to get high impact to the market. And if you don't want to trade the news, and if you don't want your edge to be affected by news, you need to stay away when the market have high impact news. Make sure to check out fastable.com using the link in the description below. So the moving average is simply the average closing prices of the selected period of time. So for example, if we want to use the 5-period moving average, we are calculating the average closing prices of the last 5 candles of any time frame. For example, if you look at this chart right here, you're going to see that we have a chart which is going up right here, and if you want to analyze this market using price action, you are going to use what is called price action trend identification, which is looking for higher highs and higher lows, and potentially the market might move going forward. But if you want to use the moving averages, we can just calculate the moving averages of these candles, and we can come up with a line that shows us that on average this number of candles, or these 5 previous candles, have been going up based on their closing prices. So the way that it is calculated is simple. Just take the closing prices of the last 5 candles and you add them and you divide by 5, because it's the 5-period moving average. For example, we take the closing price of this candle plus this candle plus this candle plus this candle plus this candle, and we add all of them and we get a number which is going to be here where the moving average is. I'm not gonna waste your time calculating this, because you just go into the market and you place the moving average on your charts and it's gonna do the thing automatically. Now here's the thing that you need to understand about moving averages, right? We have different periods. You can start from 1-period moving average, you can go for 2-period moving average, you can go for 200-period moving average, or 2000-period moving average, and it all is the same. But here's what you need to understand. If you are trading and you are using a 9-period moving average or a 5-period moving average, I'm talking about numbers that are close to 0. I'm talking about smaller numbers. You're going to see that your moving average is going to be closer to the market. I'm going to talk to you in a minute about that. So let's say we activate here the 9-period moving average. So this moving average that we put on the chart right now is the 9-period moving average. There's something that you're going to see here is the market is going to be closer to the 9-period moving average. Why? Because we are using few candles to calculate it, so it's going to be always closer to the market. And this moving average is going to show you that the market is in a strong uptrend, strong downtrend, or in a sideway. And also, if we activate the 21 period moving average, we are going to see that the market is going to be a little bit away from the moving average. For example, you can see here that the market have been going up and below of the 9-period moving average right here, but it's not going below the 21-period moving average, because now we need more candles and the moving average is going to be away from the candles. And if you go for 50-period moving average, which is right here, you're going to see that it's moving away even further from the market, because we are now using a lot of candles to create that moving averages. And how does this help you as a trader? Now look at this. Let's say you are a scalper and you only trade when the market is moving in a strong uptrend, and you only place trades in a short period of time. You can place your trade, for example, when the market was here going above the 9-period moving average, and you could be in the market for this time, and then you close out right here, right when the market closes below the moving average. This is just an example. This is not the actual strategy that I'm going to show you in a minute, but I'm saying if you are a day trader, so a scalper can get in the market right here and exit here, but a day trader or someone who is a swing trader can get into the market at the same position, right? But instead of exiting right here, you can stay in this market for as long as the market is above the 21-period moving average. You are waiting for the market to close below this 21-period moving average, which might happen later, but you can get more profits based on this. So the actual thing here is you need to know the period moving average that you are using and how is that going to affect your trading style. In a minute, I'm going to show you a complete step-by-step strategy using these moving averages. But before we do that, let me show you two different ways that you can use moving averages, right? So the first thing is trend identification. See, moving averages is not created to show you where to enter market. Why? Because the moving average calculates the data of what have already happened. So it's very hard for you to predict the future using the moving average, because it is a lagging indicator. So it pans out after the market have already moved. So the biggest or the best way of using the moving average is using the moving average as a trend identification tool. So how do you identify the market using the moving average? So you're going to use the 9-period moving average to identify short-term primary trend. So I mean the short-term trends that going to be there for, like, if let's say you're using the 5-minute time frame, it's going to be there for like 20 minutes, 30 minutes, and then the market will reverse. If you want to get those. So now, how do you use the moving averages? So the moving averages, as I said in the beginning, is created after the price have already painted. So it's a lagging indicator. So since it is a lagging indicator, it's not a good idea for us to place our trades only based on the moving average, because it's more likely that you are going to be placing your trades a little bit late. But at the same time, since it is created after the price have been created, it can help us do what is called trend identification. So trend identification is simply when you try to read the direction of the trend. So we have different types of trends. We have primary trends, secondary trends, and we have got long-term trends. So we have different moving averages for this. So for example, if you use the 9-period moving average, you are going to be catching very short-term trends, which we can call primary trends. And number two, if you are using the 50-period moving average, you can catch medium trends and you can be able to read medium trends. And then if you use the 200-period moving averages, obviously you are going to be looking for long-term trends, simply because of the periods that it takes to calculate these moving averages. So as the periods go higher, the moving average is going to be going further away from the price. Now let me show you what I mean by this. So here on the charts we have 3 moving averages. So we have the first one right here, the blue one is the 9 period moving average, and then the red one is the 21 period moving average, and then the purple one is the 50 period moving averages. So this moving averages is the moving average that I use on the strategy that I'm about to show you. And this moving average, the way that it helps me is because we are able to identify shallow pullbacks, medium pullbacks, and deep pullbacks. For example, if the market makes an impulsive move like this, and then it makes a short pullback that comes into the 9 period moving average and then goes up, I know that this trend is strong because this is a shallow pullback. At the same time, if this market moves again and make a pullback that goes to the 21 period moving average, for me that's a medium pullback. And then if the market moves and then makes a pullback that goes to the 50 period moving average, for me that's a deep pullback. So based on these three types of pullbacks, I can be able to know which types of trades am I going to place. For example, if the market is making shallow pullbacks, it is a strong trend, so I would like to place a breakout trade. So you need to place a breakout trade. Let me show you what I mean by this. So this is a strategy that I'm going to show you step by step how to do it using the moving average. But the way that what I mean is, let's say the market is moving up like this and it makes a very small pullback and it goes again to go to the upside, I would wait for a breakout here because I know this is a strong trend. It has a lot of momentum, so it will likely push further to the upside. But at the same time, if the market is moving, it makes a medium pullback like this. What am I looking for here is maybe the market, if it goes to this zone right here, it might get rejected and I can get a double top here. This is just an example. And if it is a deep pullback, we might say if the market makes a very huge pullback here, we are waiting for the market to go to the upside, and then we are waiting for the market to break again going to the downside, because it will likely not go and touch the previous zone here. So there's different things that you can do depending on how you understand these pullbacks. But today I'm going to show you a strategy and how you can use these moving averages to help you to identify what I'm talking about right here. So if you look at this chart, you are going to see that when these three moving averages are moving to the same direction in their order, being the smallest on top, followed by the next one, and then the third one, which is the bigger moving average, being away, this is when you know that this market is in a clear uptrend. The next way that you can use the moving average is to use the moving average as support or resistance. Yes, the moving average also can act as support and resistance. Sometimes when the market is moving, when it makes a pullback, the pullback might go into one of these moving averages. It's either the 9 period, the 13 period, 21 period, 50 period, or even the 200 period, or even the 100 period moving average. These are just moving average that most people use. So the market, most people are going to be looking at this zone. So it's likely that the market is going to react on this moving average. So we can use moving averages as support and resistance, and let me show you what I mean by that. So if you look at this market here, you can see that most of the time when this market was coming into these moving averages, the market was reacting and going to the other side, right? So you can see a lot of times when the market was reacting, it was reacting on these moving averages, right? So if I put again another moving average here, which is the 200 period moving average, you're going to see that the market most of the time likes to bounce on the 200 period moving average. So this is something that you just need to know, that sometimes these moving averages can act as support or resistance zone. As you can see right here, the market is reacting on the 200 period moving averages. All this time when the market was along the 200 period moving average, it was reacting to it. And also you can see right here when the market was reacting to the 9 period moving average, you can see the market reacted to the 9 period moving average maybe once, twice, 3 times, 4 times, times here, and you can see right here again it reacts on the 9 period. So you just need to keep this in mind, but you are not going to place your trades solely because the market have been reacting on the 9 period moving average. You are going to need confluence for that, which is the next thing that I need to talk about right here. So you need to understand this. When you are trading using indicators or even price action, you are using your self-fulfilling prophecy. It's only you that believes that the market is going to react, and you want to be with other traders who also believes in that, because this technical analysis that we are doing, it's not like everyone is told to trade that way. So all these things are self-fulfilling prophecy. So for you to get more confidence and for you to get better results, you want to combine different features or different factors, which comes to what is called confluence. So confluence is simply the combination or two factors or more meeting together. So for example, let's say we have two rivers that meets together. They form what is called a confluence, and they form a bigger river that is called confluence. So anything, so in trading we are talking about 2 or 3 different factors. We are talking about maybe you want to trade support and resistance, and you want to combine that support and resistance with Fibonacci, and also maybe you want to look into the RSI or any indicator just to make sure that you have good setup and you have confluence and confidence on your market, right? So for example, if we go into the market, so for example, if you look at this market right here, we can say, okay, how do we analyze this market? I would say, okay, first of all, we can see that we have an impulsive move right here. We have a pullback, and we have another impulsive move, and we have this pullback, which is right here. And then this pullback here is on the 21 period moving averages, which for me means a medium pullback. So before I just place a trade right here, one thing that I want to also know is that, okay, it's on the 21 period moving average, and the market is moving to the upside because I see all these 3 moving averages facing to the upside. And then I also see that there is an area of value right here, which is this zone where the market have reacted to. So at this point, I'm allowed to think that the market is going to go to the upside, and also I will be confident with that trade because number one, what did I see? I see the 3 moving averages facing to the upside. So that means for me the market is in an uptrend. I also see that this is an area of value where the market have reacted to before, which confirms the break and retest strategy. And also I can see that this is happening on the 21 period moving averages, which the market have been reacting to before, right? So if the market moves, I can also wait for another confirmation, maybe for a blue candle, which is for me the bull candle, right? So if I wait for this, I also get a bullish engulfing candle. So now you can see that I'm combining different things to just make sure that I end up having a good trade. So after that, I would place my trade right here. I will likely maybe lose this trade, but then this trade was placed with a lot of confluences, and it is likely to going to be a winning trade. So that's what confluence is all about. You are combining different factors to get high chances of making money in the market. So before I show you the actual strategy that I want to teach you, I want to show you an example of the trade that I placed in the afternoon using the strategy that I'm about to show you, and also using these 3 moving averages that are on the charts right now. Okay, so you just saw that this trade went on to be a very good trade. Luckily, I had shared this trade on my Telegram channel. You can join that through the link in the description below. Now let's go ahead and let me show you a step-by-step strategy that you can use to trade this market. So to create any strategy, we use a system called the CEST, and just for disclaimer, I'm not the one who created this system. I learned it from the trading channel, right? So the CEST is an analogy for a system that we use to create a rule-based strategy, right? So the C stands for conditions, right? So the conditions is what do you want to see before you place your trades, right? Number 2, we have the entry rules or the entry triggers, right? What is it that you see to confirm that this is where I should place the trade. So right, so let's say you see the conditions being anything like the trend line, the Fibonacci, and then we have the entry rules. These can be double tops, double bottoms, candlestick pattern, RSI crossovers, and all the things like that. We also have the stops, right? The stops is where do you exit the market with a loss if the market goes the wrong way, because remember, you are not going to win 100% of your trades. No matter how good you become as a trader, you are going to have those losses. So you need to know, when am I cutting my losses if the market goes in the wrong way. And then the targets, of course, we want to make money. So if the market goes in my direction, when am I saying enough, I'm getting out of this market and I'm taking this? So let me show you a step-by-step strategy that I created using this and these 3 moving averages. Now, for this strategy, what you want to do is you want to be able to identify a market which is in an uptrend or in a downtrend. And how do you know this? First is the conditions, right? So the first conditions that we want to see here is, number 1, we want to see these 3 moving averages lining up in their order. So we want to see the 9-period moving average being up here, and followed by the 21 and followed by the 50 in this order, right? So we want this to be above, followed by the 21 and followed by the 50. Forgive me for the drawing, it's terrible. So if these moving averages are moving in the same direction and there's a gap between them, we know that this market is in a strong uptrend, right? And also we want to see on the point of placing your trades, you want to see the market being above all the 3 moving averages. So once you do this, this is the condition number 1. Condition number 2 is you want to make sure that there is a pullback that comes to the 9-period moving average, right? So this 9-period moving average right here, we want the market to come back into the 9-period moving averages. And the reason why you want the market to be above the 9-period moving average is because you want to make sure that there is momentum, so that your trade is going to be going to the profits real fast, right? So condition number 2, you want to wait for a pullback that comes into the 9-period, and this pullback, the candle can cross the 9-period moving average, right? And the wick of the candle can also cross the 21 period like here, but the body of the candle should not close below the 21 period. So you understand what I'm saying? I'm saying if this pullback here should come back to the 9 period, but the body of the candle can go past the 9 period, but body of the candle should never go and cross below the 21 period moving average. And once you do this, we want to wait again. So once we see this condition number 1, the moving averages are moving to the same direction and the trend is clear. Number 2, we want the market to be above all the trends. Number 3, we want to wait for a pullback that makes, and on the pullback we want to make sure that the body of the candle doesn't cross below the 21 period moving average. And after that, the next thing that you do is you mark out this zone here, the top part here of the pullback. Mark out the top part of the pullback, and then you wait for the market to go, and then you wait for the market to close above where you marked, right? So here you can see the wicks can go below 21, but the body should not close below 21. And then we wait for the market to go up and above our marked zone, and then can place our buy trade. So this is an example. So I'm a little bit late, but you would have wanted to place your trades. If the green candle here, or blue candle in my case, crosses above and or breaks above this zone that you marked, you buy, and then you place your stop loss below the 21 or even the 9 if you are aggressive with it, and then you take 1:1.5 risk to reward ratio, and then you wait for the market to go to the profit. If it does, sometimes it will, sometimes it will not. You are not going to win all your trades. Remember that these are examples, and it's a little bit hard to do it in a real market, but you just saw in the example that I gave you that if you are concentrated and if you know what you are doing, you can set alerts on this trading view to know if the market breaks here. You need to have a list of setups that you can place. So in this case, this was going to be a winning trade. Now here's one thing that you need to understand about these strategies that we share. You need to backtest these strategies before using them, and there's different reasons why you need to backtest your strategies. Number one, if you backtest your strategy, you are going to get familiar with it. It's different from just watching me here giving you 2 or 3 examples and then you go and try to do it yourself. It's different. You need to go into the market. You need to go back with your trading view or your MetaTrader. Go come with the market, move the market and try to identify all the times that this happens. In testing it, you're also getting familiar with it. Imagine, for me, it's easier for me to identify this type of a trade because I've been trading this type of trade for a long time and I've backtested it hundreds of times, and I can see it with just one glance to the screen. If I just look at the screen, if the setup is there, I can easily see it. But it happens after I saw it hundreds of times, right, as I was testing and now as I'm trading it. So the second reason why you should backtest is you are also going to know the performance of your strategy, of your setups. So if the setup is performing good at 1:1.5 risk to reward ratio, it doesn't mean that if you do 1:3 or 1:5 risk to reward ratio, it's gonna work. The results can change dramatically. So you need to backtest so that you know the performance and how it works in that particular currency pair. Number 3 reason why you should backtest these strategies is for emotional control. So on backtesting, you can see your strategy losing 3, 4, 5, 6 times in a row. And if you get used to seeing that, that means in the next time when you are placing your trades, it means if your strategy loses 5 times in a row, you don't panic. You know that this happens and my strategy from the backtest, it can bounce back from this. You're not going to panic. You're not going to change the strategy because you know how it performs. That's a big reason why you should backtest your strategy. So now let me give you another example of the sell trade of the same strategy. Okay, now here's a market which meets our criteria, right? First of all, we want to see these moving averages moving in their same direction. So the conditions is, number one, since this is a sell trade, we want to see the 9-period moving averages being down here, followed by the 21 and then followed by 50, and we want to see gap between them and we want them all to face to the downside. Now we have identified our trend. Next thing that we want to do is we want to see the market which is coming back into the 9-period moving average. Remember, so the market is moving like this, moves to the downside, it reverses back into the 9-period moving average. Remember, we said if we see a pullback here, it can go all the way, but we want to make sure that the wick can go above the 21, but no body of any candle here should go above the 21. So the wick can go, but the body should never go above the 21. What if the market doesn't go to the 21 and just stayed to the 9? It is totally fine. That is going to be a higher probability trade. If the 21 is away from the 9 and the market pulls back into the 9 and doesn't go to the 21, it's a high probability trade. You can use bigger risk on that. So once we see this, the next thing that we want to do is we want to look for our entry. So to look for the entry, we just mark out the low side here. Once we mark out this lower side, we let the market move and we wait for the candle that first closes below this zone. So now the market isn't closed below the zone yet, so we don't place our trade. So let's see what happens next. Now we have another candle which closes, right? So here I'm a little bit late right here, but you could have seen that the market closes below right here. So when the market closes right here, we're supposed to place a trade right here. And then once we see this close below, that's our entry trigger. For the stop loss, we want to put our stop loss above this 9-period or even to the 21 period right here. So if you want to be aggressive, you can just put it above the 9 and then you put 1:1.5 risk to reward ratio. And then in this case, you can see already that the market had already won right here. So this is a good strategy, but you need to be very careful to not fall for all the cases when the market is not in a clear trend. For example, when the market is looking like this, right? So you could have said, okay, here 9 is above, the 21 is below and the 50, so here you could have placed the trade. But you just want to avoid these cases. You want when there is a clear trend, for example here. So let's say the market was here, because I'm using the market replay mode here, but let's say the market was here. You can clearly see that there is gap between these moving averages. So there is clear gap and there's no doubt that we are in a downtrend direction. So when you see this, this is when you start to look for trades. So guys, if you want to learn more about this, I'm putting together a course. Maybe when you watch this video, the course might be already out. This course is going to be free for you to join this course. And if you are watching this, make sure you join our Telegram channel. I will leave the link in the description below so that you can get updates on what is happening. We are also building a forum on our website, a place where we can discuss and where we can talk about trading things. So it's going to be ready this week, so I'm going to launch it, and I want you guys to run there, and let's just make this one of the biggest trading forums on the channel. Thank you for watching this video. If you want to learn more about trading, make sure to subscribe to the channel. We come up with content like this each and every week. Thank you. I will see you in the next one.